Today, we're going to explore numerical methods used to price options. This topic is important because it helps us understand how to determine the value of options when exact formulas are difficult or impossible to apply. We'll look at different techniques and approaches to calculate option prices accurately and efficiently. This foundation will set the stage for deeper discussions in the upcoming slides. Price options play a crucial role across various areas in finance, starting with risk management, where companies and funds rely on correctly priced options to hedge against potential losses effectively. Then there's trading, where precise pricing is essential because it supports both arbitrage and algorithmic strategies that help maximize profits. When it comes to product innovation, accurate pricing allows for the development of more complex financial instruments like exotic derivatives and structured products. Portfolio analytics also benefits since the sensitivities, or Greeks, derived from pricing models are key in guiding exposure and hedging decisions. On the transparency front, fair and consistent pricing helps build investor trust, especially on fintech trading platforms. Compliance with regulatory standards is another reason pricing needs to be reliable, as it ensures valuation is consistent and model-based. Finally, integrating AI and machine learning has become important because these technologies enhance both the speed and accuracy of option pricing, making the entire process more efficient and robust. To start, financial options are contracts that give the holder the right, but not the obligation, to buy or sell an asset at a predetermined price within a set time frame. These come in two main types: call options, which allow buying, and put options, which allow selling. In the world of fintech, options play a crucial role in trading strategies, managing risk, and creating complex financial products known as derivatives. Because options can depend on various factors like price paths and timing of exercise, their valuation often becomes quite complex. This complexity means that numerical methods are essential for accurately pricing options, especially when dealing with features like path dependence or the possibility of early exercise, which traditional analytical formulas can't handle effectively. When it comes to option pricing, there are two main approaches: analytical methods and numerical methods. The Black-Scholes formula is a well-known analytical method, but it only applies to European options, which can only be exercised at expiration. For American or more complex exotic options, the Black-Scholes formula falls short because these options can be exercised at different times or have additional features. In those cases, we rely on numerical methods like binomial trees or finite difference methods, which provide more flexibility to handle the complexities of these types of options. Let's look at an example of how to price a European call option. We start with the stock price set at 100, and the strike price is also 100, which means the option is at the money. The time to maturity is 1 year. We assume a risk-free rate of 5%, or 0.05 in decimal form. The volatility of the stock, which measures how much the price fluctuates, is 20%, or 0.2. With these values, we have everything we need to calculate the option price using the pricing model we'll apply next. The question marks and exclamation point in the image represent the process of finding the answer based on these given parameters. The Black-Scholes formula helps us determine the fair price of a European call option. It combines the current stock price and the present value of the option's strike price, adjusted for risk and time, using cumulative normal distribution functions of two factors, D1 and D2. These factors depend on the stock price, strike price, risk-free interest rate, volatility, and time until expiration. Essentially, D1 captures the expected return adjusted for volatility and time, while D2 represents a downward adjustment from D1 by the volatility over the square root of time, reflecting the uncertainty as the option approaches expiration. This formula provides a foundational method to price options by considering both the potential growth of the underlying asset and the time value of money. Now, let's calculate the values of D1 and D2, which are important for the next steps. For D1, we use the formula involving the natural logarithm of the ratio of the stock price to the strike price, plus the risk-free rate and half the variance multiplied by the time to maturity. Plugging in the numbers, we get 0.35 for D1. Then, we find D2 by subtracting the volatility term from D1, giving us 0.15. Next, we use the cumulative distribution function of the normal distribution to find the probabilities associated with these values. According to standard normal distribution tables or using functions like scipy.stats.norm.cdf, we find that the cumulative probability for D1 is about 0.6368, and for D2, It is around 0.5596. These values will help us calculate the option price in the following steps. To find the call price, we multiply 100 by 0.6368, which gives us 63.68. Then, we calculate 100 times e to the power of negative 0.05, which equals 95.12, and multiply that by 0.5596, resulting in 53.29. Subtracting 53.29 from 63.68 leaves us with 10.39. So, the approximate price for the European call option is 10.39. Here we see two different types of options, call options and put options. The call option, represented by the green upward trending line, increases in price as the underlying asset's price goes up. This means that if you buy a call option, you are betting that the price will rise, allowing you to buy the asset at a lower price than the market value. On the other hand, the put option is shown with a red downward trending line, which goes down as the asset's price increases. Buying a put option means you expect the price to fall, so you can sell the asset at a higher price than the market. Understanding these basic price movements is key to grasping how options can be used for trading or hedging. When we look at call options, they give you the right to buy a security at a set price before the option expires. You're not forced to buy if you don't want to, and if the price goes up a lot, your potential gains can be unlimited because you benefit from the rise. Investors typically buy calls when they expect the price to increase. On the other hand, put options give you the right to sell a security at a predetermined price before expiration. Like calls, you're not obligated to sell, but your gains are limited since the price can only fall so much. Investors usually buy puts when they anticipate a price drop. These differences help you decide which option aligns with your expectations about the market movement.